War broke out, oil prices surged, but gold collapsed. And the reason isn't what you think. In January, gold hit its highest level in history, $5,595. Today, it's trading around $4,100. That's a drop of roughly 25% from the peak. Gold's worst quarter in 13 years. Normally, this shouldn't be possible. For centuries, gold has been known as the ultimate safe haven. When war, crisis, or uncertainty rises, investors run to gold. Right now, those exact conditions exist. An active conflict between the U.S. and Iran is ongoing, and oil prices have been climbing for weeks. In theory, gold should be rising too. Instead, the opposite is happening. The reason isn't fear, it's interest rates. Holding gold comes with a cost. It pays you no yield, no interest. You only profit if the price goes up. That's why gold's real competitor isn't war. It's interest-bearing assets, bonds, savings deposits, money market funds. Now follow this chain. War pushes oil prices higher. Higher oil fuels inflation. As inflation rises, so does the likelihood that the Federal Reserve, America's central bank, will raise interest rates. Right now, the market is pricing in at least one rate hike by the end of the year. This is where opportunity cost comes in. As interest rates rise, holding gold, which pays no return at all, becomes more expensive compared to earning interest in bonds or savings accounts. So investors pull money out of gold and move it into interest-bearing assets. The result, fear is rising, but gold is falling. This isn't actually happening for the first time. Back in 2013, we saw a similar pattern. The moment the Fed simply signaled it might raise rates, before it even did, gold lost about 28% of its value that year. There was no war, no crisis. The only cause was the expectation of future interest rates. What's happening today is that same mechanism now layered on top of an actual war. But the story doesn't end there. During this same period, China's central bank made its largest monthly gold purchase in over 2.5 years in June. So while short-term investors are fleeing gold, central banks are quietly stockpiling it. This shows two different time horizons operating in the market at once. Short-term money is chasing interest, while long-term capital still trusts gold. In fact, JPMorgan projects gold could climb back to $6,000 by year-end. Though that forecast depends heavily on the Fed's next move. This is one of the most misunderstood truths in financial markets. What determines an asset's price isn't the headlines of the moment. It's expectations about future interest rates. War headlines affect you emotionally. But what actually moves the market is what the Fed does at its next meeting. The one lesson to take from this: don't watch the headlines, watch interest rate expectations. If the odds of a Fed rate hike rise, pressure on gold could continue. If the Fed backs off, gold could recover quickly. The real indicator to track isn't the war, it's what the Fed says.